Right now, while most investors are panicking, while they're selling everything they own, while the financial media screams about crashes and chaos, a small group of people is doing something completely different. They're not running away from this crisis. They're running toward it because they know something that 99% of investors have forgotten, something that's been proven in every major conflict since World War II, something that turned ordinary people into millionaires during Iraq, during Libya, during Ukraine, and it's about to happen again. But here's what nobody's telling you. The window is closing faster than anyone realizes, and by the end of this video, you'll understand exactly why. Welcome, friend. Welcome to John AG. If this is your first time here, let me take a moment to introduce ourselves properly. This channel exists for one simple reason: to cut through the noise and give you the truth about what's really happening with your money. Now, I'd like to ask you something, and I mean this sincerely. If you've been around long enough to remember when evening news was delivered by trusted voices who actually explained things, when financial analysis meant more than 5-second panic clips, then you'll appreciate what we do here. We don't shout, we don't hype, we analyze. So here's what I'm asking. If you value that kind of straightforward, respectful approach to serious topics, would you click that subscribe button? Not because everyone else is doing it, but because you genuinely want to stay informed. Think of it as joining a conversation among people who refuse to make financial decisions based on fear or headlines. And one more thing, I'm always curious about our community. Would you take a second to comment below and tell me where you're watching this from? Your city, your country? I find it remarkable how these discussions reach people in every corner of the world. Whether you're watching from New York or New Delhi, London or Lagos, let me know. It matters. All right, let's get into it. The world is watching the Middle East again. Tensions between the United States and Iran have reached a boiling point, and financial markets are reacting exactly the way they always do, with fear, confusion, and wild volatility. Stock prices are swinging hundreds of points in single sessions. Oil prices are spiking. Gold is climbing. And investors everywhere are asking the same desperate question: what should I do with my money? But here's what most people don't understand. This isn't the first time this story has been told. In fact, it's a story that repeats itself with remarkable consistency throughout modern history. And for those who know how to read the patterns, these moments of crisis don't represent danger. They represent something else entirely. They represent opportunity. The Strait of Hormuz is a narrow waterway between Iran and Oman. Most people have never heard of it. But every single day, roughly 20% of the world's oil supply passes through that tiny channel. That's not a small detail. That's the entire global economy compressed into a geographic choke point that's only 21 miles wide at its narrowest point. When Iran threatens to close the Strait of Hormuz, they're not making empty gestures. They're reminding the world that they control one of the most critical supply lines on the planet. And when the United States responds with military positioning, sanctions, or diplomatic pressure, they're acknowledging that same reality. This isn't about politics. This is about power, resources, and strategic control. Now, here's where things get interesting for investors. Every time a major geopolitical conflict emerges in a resource-critical region, the same pattern unfolds. First, there's shock. Markets drop. Investors panic. Everyone rushes to sell anything that feels risky. Headlines scream about impending disaster, and the fear becomes contagious. But then something else happens. Smart money, the institutional investors, the hedge funds, the people who manage billions of dollars, they don't panic. They calculate, they analyze, and they start positioning themselves for what comes next. Because history has taught them a valuable lesson. Geopolitical conflict doesn't destroy markets. It reorganizes them. Let's go back for a moment. In 2003, when the United States invaded Iraq, the initial market reaction was panic. The S&P 500 dropped. Investors fled to safety. But within months, certain sectors began outperforming dramatically. Energy companies posted record gains. Defense contractors saw their stock prices double and triple. Companies involved in reconstruction, logistics, and security services experienced explosive growth. The same pattern emerged in 2011 during the Libyan conflict. The same pattern emerged in 2014 when Russia annexed Crimea. The same pattern emerged in 2022 when Russia invaded Ukraine. Shock, adjustment, opportunity. The investors who panicked and sold during the shock phase lost money. The investors who understood the pattern and positioned themselves strategically during the adjustment phase made fortunes. And right now, that pattern is unfolding again. The US-Iran conflict is not some random, unpredictable event. It's a high-stakes chess match between two nations with deeply entrenched positions. Both sides have objectives. Both sides have constraints. And both sides know that outright war is catastrophically expensive for everyone involved. What that means is this. The most likely scenario is not total chaos. The most likely scenario is prolonged tension, periodic escalation, military posturing, sanctions, and regional instability that persists for months or even years. And for investors who understand what that means, it's not a crisis, it's a roadmap. In the next section, we're going to break down exactly which sectors benefit when this kind of conflict unfolds. We're going to look at the data, the historical performance numbers, and the specific mechanisms that drive capital from one part of the market to another. Because this isn't about guessing. This is about understanding how the system actually works. There's a phrase that circulates quietly among professional traders, and most retail investors never hear it. War is a transfer of wealth, not a destruction of it. It sounds cold. It sounds calculated, but it's also mathematically accurate. When geopolitical conflict erupts, money doesn't disappear. It simply changes hands. It moves from those who react emotionally to those who position strategically. And it flows into specific sectors with the precision of water finding the lowest point in a landscape. The question isn't whether money will move. The question is, where does it go? Let's start with the obvious one, energy. When the Strait of Hormuz becomes a topic of conversation in Washington and Tehran, oil traders don't wait for actual disruptions to happen. They price in the risk of disruption immediately. That's how markets work. They move on probability, not certainty. In 2019, when Iranian forces seized a British oil tanker, Brent crude jumped 6% in a single day. No oil supply was actually cut. No ships stopped moving. But the perception of risk was enough to trigger billions of dollars in price adjustments across global energy markets. Now, here's where most investors get it wrong. They see oil prices spike, and they assume the play is simple. Buy oil stocks, wait for prices to climb higher, sell when tensions ease. But that's not how the sophisticated players approach it. Professional investors break the energy sector into layers. The first layer is the oil majors, companies like ExxonMobil, Chevron, BP. These are stable, dividend-paying giants. They benefit from higher oil prices, but their size also makes them slow to move. They're defensive positions, not aggressive growth plays. The second layer is the independent producers, smaller companies focused on specific regions or extraction methods. These stocks are more volatile, but they also offer higher upside when oil prices surge. During the 2022 Russia-Ukraine conflict, some independent oil producers saw their stock prices increase by 80% to 120% within 6 months. But the third layer is where things get interesting. This is the layer most people ignore entirely. The service and logistics companies, the businesses that transport oil, store oil, ensure oil shipments, and provide the infrastructure that makes global energy markets function. When tensions escalate in the Middle East, shipping routes change. Tankers take longer paths to avoid conflict zones. Insurance premiums for vessels passing through high-risk areas spike dramatically. And the companies that own those tankers, provide that insurance, and manage those logistics, see their revenues increase whether oil prices go up or down. In 2020, amid heightened U.S.-Iran tensions, the stock price of a major oil tanker company increased by 40% in 4 months. Not because oil prices soared, but because shipping demand and insurance fees created a structural advantage that nobody was paying attention to. That's the difference between obvious plays and asymmetric opportunities. Now let's talk about defense. The United States defense budget is approximately $850 billion per year. That number doesn't shrink during peacetime, and it expands rapidly during periods of heightened conflict. Defense contractors don't rely on consumer spending or economic cycles. They rely on government contracts, procurement timelines, and geopolitical necessity. When tensions with Iran escalate, the Pentagon doesn't just respond with existing equipment. They accelerate procurement. They expand surveillance. They deploy advanced systems. The companies that manufacture those systems see immediate financial impact. But here's what separates informed analysis from surface-level thinking. The defense sector isn't just about fighter jets and missiles anymore. It's about cybersecurity firms that protect critical infrastructure. It's about satellite companies that provide intelligence and communication networks. It's about drone manufacturers and autonomous systems developers. During the 2020 U.S.-Iran standoff, shares of a leading defense cybersecurity firm increased by 35% in 3 months. Not because of bombs or bullets, but because modern conflict is fought across digital networks as much as physical territory. Then there's the sector that almost nobody discusses, commodities beyond oil. Gold gets all the attention as the traditional safe haven asset. And yes, gold typically rises during geopolitical uncertainty. But there's a lesser-known pattern that repeats itself with remarkable consistency. Industrial metals, copper, aluminum, steel, often experience supply chain disruptions during Middle East conflicts. Not because these metals come from Iran, but because shipping routes, manufacturing hubs, and trade flows get disrupted across the entire region. In 2011, during the Libyan conflict, copper prices increased by 22% within 5 months. Why? Because global supply chains anticipated disruptions, manufacturers accelerated purchases to build inventory buffers, and speculative traders positioned for scarcity. The same principle applies today. If US-Iran tensions escalate into broader regional instability, industrial metals markets will react before physical shortages ever materialize. And that's the core lesson of this entire section. Markets don't wait for disasters to happen. They price in the possibility of disaster. And investors who understand that distinction position themselves accordingly, not by chasing headlines, but by recognizing structural advantages that emerge when capital flows predictably from fear into calculated opportunity. The sectors outlined here aren't guesses. They're historical patterns, backed by decades of data, and they're unfolding right now. Knowing where money flows is valuable. Knowing how to position for that flow without destroying your portfolio is what separates theory from execution. Because here's the uncomfortable truth that nobody wants to say out loud. Most investors who try to profit from geopolitical conflict end up losing money, not because they picked the wrong sectors, not because they misread the situation, but because they had no operational discipline when placing their bets. They went all in when they should have scaled in. They chased price spikes when they should have waited for pullbacks. They held positions too long because they fell in love with their thesis. And they ignored the single most important rule of conflict investing. Never risk what you can't afford to lose while the outcome is still uncertain. So let's talk about how this actually works in practice. Think of portfolio construction during geopolitical instability like building a house in earthquake territory. You don't build a rigid structure that assumes the ground will never move. You build flexibility into the foundation. You create zones of stability and zones of calculated risk, and you accept that some parts of the structure will absorb shocks so that others can remain intact. Professional investors use a framework called the 10-20-70 rule during periods of heightened uncertainty. 10% of the portfolio goes into aggressive, high-conviction conflict plays. These are the positions where the thesis is clear, the upside is substantial, and the risk is acknowledged. This might be a defense contractor with a strong government contract pipeline. It might be an independent oil producer in a geographically advantaged region. It might be a logistics company positioned to benefit from rerouted shipping lanes. These positions are not designed to be safe. They're designed to capture asymmetric returns if the thesis plays out. 20% goes into defensive positions that benefit from uncertainty without requiring a specific outcome. Gold, treasury bonds, utility stocks, these aren't exciting. They don't double in 3 months. But they provide ballast when volatility spikes unexpectedly, and they preserve capital when other parts of the portfolio experience drawdowns. 70% remains in core holdings, diversified, stable positions that are structurally insulated from short-term geopolitical noise. These might be technology companies with global revenue streams, healthcare firms with recession-resistant business models, consumer staples that people buy regardless of headlines. This structure ensures that even if the aggressive thesis completely fails, the portfolio doesn't implode. It ensures that capital preservation and capital appreciation exist simultaneously, and it removes the emotional pressure that forces bad decisions during moments of peak volatility. Now let's talk about entry timing, because this is where most people go wrong. When conflict headlines hit, there's an immediate price reaction. Energy stocks spike, defense stocks spike, safe haven assets spike. And the instinct, the overwhelming powerful instinct, is to buy immediately before prices run even higher. But here's what the data shows across decades of conflict cycles. The initial spike is almost always followed by a pullback. Not because the thesis is wrong, but because early buyers take profits, late buyers get shaken out, and markets recalibrate as the initial panic fades. In January 2020, after the US drone strike that killed Iranian General Qasem Soleimani, oil prices jumped 4% overnight. Defense stocks surged, gold spiked to multi-year highs, and within 72 hours, nearly all of those gains had reversed as traders realized that immediate escalation wasn't happening. The investors who chased the spike lost money. The investors who waited for the pullback, then entered positions systematically over the following 2 weeks, captured the sustained move that followed as tensions remained elevated throughout the quarter. That's the difference between reacting and positioning. Systematic entry means splitting capital into tranches. The first tranche goes in after the initial spike fades. The second tranche goes in if the thesis strengthens and prices pull back further. The third tranche is held in reserve for unexpected opportunities, a panic sell-off that creates a discounted entry or a secondary escalation that reopens the window. This approach eliminates the need to time the perfect entry. It eliminates the emotional pressure of going all in at once, and it ensures that if the thesis takes longer to play out than expected, capital isn't fully deployed at suboptimal prices. Then there's the exit strategy, and this is where discipline matters most. Conflict trades are not long-term holdings. They are tactical positions designed to capture a specific window of opportunity. When that window closes, when tensions ease, when diplomatic breakthroughs occur, when prices normalize, the position must be closed regardless of whether more upside feels possible. Professional traders set exit targets before entering positions. If an energy stock increases 30%, They sell half and let the rest run with a trailing stop. If a defense contractor hits predetermined resistance, they take profits and move on. They don't fall in love with the story. They execute the plan. Because in conflict investing, the goal is not to ride every wave to its peak. The goal is to capture predictable moves, protect gains, and avoid being the last person holding when the music stops. This is the framework. This is how money is made when the world gets noisy. There's a reason historians study the past, not for nostalgia, not for academic curiosity, but because human behavior, market psychology, and geopolitical mechanics follow patterns that repeat with startling consistency. The names change, the technology evolves, but the underlying structure remains the same. And when it comes to conflict investing, history doesn't just offer lessons, it offers blueprints. Let's go back to March 2003. The United States is preparing to invade Iraq. Global markets are gripped by uncertainty. The S&P 500 has already fallen 15% from its peak as investors anticipate chaos. Cable news runs countdown clocks. Analysts predict oil prices will skyrocket past $100 per barrel and trigger a global recession. Then the invasion begins, and something unexpected happens. Within 3 weeks, the S&P 500 bottoms and begins a rally that lasts for years. Oil prices spike briefly, then stabilize, and certain sectors deliver extraordinary returns that few predicted. Defense contractors see their stock prices surge by 40% to 60% over the following 12 months. Not because of short-term volatility, but because the conflict creates sustained government spending that lasts for years. Halliburton, a company involved in reconstruction and logistics, sees its stock price increase by over 300% between 2003 and 2007. Energy companies benefit not from crisis, but from structural shifts in global supply. Oil service firms post record profits as demand for drilling, infrastructure, and security services expands across multiple theaters. The lesson isn't that war is profitable. The lesson is that the market's initial panic reaction was wrong. The investors who sold everything in fear missed the entire recovery. The investors who positioned strategically during the panic captured returns that defined their portfolios for the next decade. Now fast forward to February 2022. Russia invades Ukraine. Markets plunge immediately. The S&P 500 drops 12% in 3 weeks. European indices fall even harder. Investors flee to cash, convinced that global conflict will derail economic growth. But then the pattern repeats again. Energy stocks explode. European natural gas prices increase by 300%. U.S. oil producers see their stocks double within 6 months. Defense spending across NATO countries surges to levels not seen since the Cold War. Companies manufacturing weapon systems, drones, and surveillance technology experience demand shocks that reshape their entire financial outlook. Palantir, a data analytics firm with defense contracts, sees its stock rise by 85% in the first 4 months of the conflict. Lockheed Martin, Northrop Grumman, and Raytheon all post significant gains. Agricultural commodity prices spike as Ukraine's wheat exports are disrupted, benefiting grain producers in North America and South America. And once again, the investors who panicked and sold during the initial shock missed the entire move. The investors who studied the historical pattern, positioned strategically, and maintained discipline captured returns that outpaced the broader market by substantial margins. Now, let's apply this framework to the current US-Iran situation. There are 3 primary scenarios, each with different probability weightings based on historical precedent and current geopolitical constraints. Scenario A is limited strikes and contained escalation. This carries approximately 60% probability. In this scenario, tensions remain elevated, periodic military actions occur, but neither side pursues full-scale war. Oil prices remain elevated but stable. Defense spending increases modestly. Shipping insurance costs rise. This creates sustained opportunities in energy logistics, defense technology, and regional security firms. Scenario B is prolonged regional conflict without direct US-Iran war. This carries approximately 30% probability. Proxy conflicts intensify across the Middle East. Sanctions tighten. Supply chain disruptions increase. Oil prices spike periodically but don't sustain extreme highs. Defense contractors benefit significantly. Industrial metals experience supply shocks. Safe haven assets see sustained inflows. Scenario C is full-scale military engagement. This carries approximately 10% probability. This is the scenario everyone fears, but history suggests is least likely. The economic cost for both nations would be catastrophic. Global markets would experience severe short-term disruption. However, even in this scenario, historical data shows that certain sectors still outperform dramatically within 6 to 12 months. The critical insight is this: investors don't need to predict which scenario will unfold. They need to position for the weighted average outcome across all scenarios. That means holding energy exposure that benefits in scenarios A and B. It means maintaining defense positions that outperform in all 3 scenarios. It means keeping safe haven allocations that protect capital if scenario C materializes. And it means avoiding the mistake of going all in on any single outcome. History has provided the roadmap. The Iraq War showed how panic creates opportunity. The Ukraine conflict demonstrated that structural sector advantages persist far longer than initial volatility. And decades of Middle East tensions have proven that the Strait of Hormuz creates predictable price distortions every time it becomes a flashpoint. The US-Iran conflict is not a unique event. It's the latest chapter in a story that's been told repeatedly throughout modern financial history. The question isn't whether opportunity exists. The question is whether investors have the knowledge, discipline, and emotional control to position for it systematically instead of reacting to it emotionally. Because in the end, markets reward preparation. They punish panic, and they transfer wealth from those who react to headlines to those who understand the patterns beneath them. The world will continue to be uncertain. Conflicts will continue to emerge, and investors will continue to face the same choice they've always faced: react emotionally or position strategically. History has spoken, the data is clear, the framework exists. What happens next is simply a matter of execution.